This is the Euro-dollar weekly data from back in March 2020. This is almost a year's worth, a little more than a year's worth of data into April 2021. And boy, you can make a whole course out of this time period, because if every section of this was just an almost ideal Elliott wave section. Of course, we're going to look at it past this data and develop some trading strategies based on the pattern and position. But let's take a look at where we're at as of the last bar of this chart. We had an obvious 1 and then a 2, nice ABC, 1, 2, 3, 4, 5 into a wave 3, an extended wave 3, typical of the wave 3s, an ABC, simple, pretty simple zigzag, kind of between a zigzag and a flat, but just ideal ABC for a wave 4, and then just again ideal 5-wave advance into the wave 5 of 5 high to complete a 5-wave impulse trend into the January 2021 high. Well, once the wave 5 was confirmed as being complete just a week later by a trade below the wave 4 of 5 low, or 4 of 5 low, we would anticipate a correction greater, typically at least greater in time and price, than any correction within the 5-wave trend. And by far the largest correction, certainly in time, well, in price also, was this wave 4, which is, what's that? It's about 2 months, about 8 weeks. So we'd anticipate we'd have about an 8-week or longer correction against this trend. And the basic Elliott wave guideline is what? A correction typically against a 5-wave trend corrects down into the wave 4 of lesser degree. And frequently, the correction terminates near the extreme of the wave 4. So we have this zone would be the probability where the correction would continue to over 2 months or more. So let's look at the last bar in the chart. And again, it was so obviously on weekly data is that coming off of the January high, there is a nice ABC correction. Could that have been the complete correction against this more than 1 year, or almost a year, 5-wave trend? Pretty unlikely. It was only 4 weeks, so it's really short in time and price to be a larger degree correction than either any of the corrections within the 5-wave trend. So more than likely it was just a wave A, and then there'd be a correction and then another decline before this higher time frame correction was complete. So ABC probable A, and then we did have an ABC advance to complete a wave B, and then potentially another ABC decline. So I have these labeled as an A and a B, and then a possible ABC decline to connect two ABCs. We call them double threes. It's in traditional Elliott wave terms, it's really, and it really is better labeled as a W and an X. When it's a WXY instead of an ABC, the A should be a 3, the B should be any type of correction, but it's typically a 3. And then the C is 3 sections in ABC. So instead of calling it a higher time frame ABC, Elliott in Elliott wave academics, they came up with, well, let's call it a WXY to distinguish that the wave C can be 3 sections. So that's why I have both of these on here, just so you'll recognize them when you see other charts. As of the last weekly bar in this chart, declined longer in time than this wave 4, declined greater in price than this wave 4, and declined into the zone of this wave 4 pretty close to the extreme of the wave 4. So just based on basic Elliott wave guidelines, is the euro is in a position to complete a correction against this 5-wave trend. And if that's the case, that's really significant. very significant. For once we complete this correction, the follow-up should be a resumption of the trend prior to the correction to a new extreme. That would mean to a new high above this January high. So let's ratchet down to the daily data and see if we can identify a specific trade strategy. Our first objective is this wave C. Is it breaking down nicely into a 5-wave impulse trend, because it should subdivide into 5 waves. And if we can identify if it's in a position to complete a wave 5, it'd be in a position to complete this ABC. And that would make it in a position to complete the much higher time frame correction. So let's go to the daily data. And this is the daily data as of that last weekly bar on the chart. So again, from January high, ABC, ABC, another ABC, and the C should subdivide into 5 waves. And look at, boy, going into late March, again, almost ideal, 1, 2, 3, 4, and potentially in a position to complete wave 5 of this, and which would complete the entire correction going back to January. So in a very important position. So this is a complex correction of some sort, and with a complex correction, it can really continue on for a long ways, but we have at least these multi-week lows when we get to points similar to this, where this A is, and we're at another point similar to where that A is, comparable, probable comparable low to this A. So that would be what's that, 3 or 4 week advance following this low, whether we complete the higher time frame correction or not. Isn't this a great tradable setup for at least a low that's probably going to last 3 or 4 weeks, if not many months, and continue to above the January high? Well, the answer to that is, boy, it is. It's a great setup. And let's just go down one more notch to the 240-minute data. And by the way, we don't need to have intraday data to make these decisions. Now, if you're trading like Forex, highly leveraged markets, you should get down to intraday data for at least for your entries and for your stop adjustments when you get to critical waypoints as the market progresses. But you don't need to trade highly leveraged. Keep in mind there's ETFs that you could trade. I think it's FXE is the ETF that trends tick for tick with the euro itself. So you can use this information even if you got a day job and you can't follow the market during the day, and use this analysis for unleveraged positions. What would indicate that this decline is complete? Well, an advance above the probable wave 4 high. That would mean this 5-wave decline is complete, which has probably completed this other ABC section, which has the potential again to complete the entire section going all the way back to January. So great setup just above this probable wave 4 high. However, like I said, we can go to the 240-minute data, go to some intraday data here. And again, you don't have to even be following it during the day. You can download intraday data at the end of the day and break it down and look at the end of the day where the market's at and see if you can break it down and get a closer entry than you would have on the daily data. So here's the intraday data as of that last daily bar in the chart. So again, probable 1, 2, 3, 4, and a potential for a wave 5. Boy, if we even broke this down, looks like a 1, 2, 3, 4, 5. And then bounced up here for several bars, and this itself is a greater advance than any within this wave 5. That's called an overbalance of price end time, and it's a signal that this section is complete. It's not a definitive signal, but let's just say it's a red flag or a warning signal that this is complete. What would be a trade strategy if we believed that, well, not if we believe, but what we know is that this has subdivided nicely into 5 ways into this low. We don't know if this low is it or not, but we've had this advance. What would be a trade strategy for a simple entry strategy with a defined entry price and absolutely a defined protective stop loss? Well, we've come up, we've gone sideways. This is the entry strategy that I use probably 70, 80%, maybe 90% of the trades I make is we go down to a fairly small time frame, and if everything has come together at this point, then we have an advance, we have some decline. If we take out this high, that's a buy stop to go long with a protective sell stop below the low made prior to exceeding the high. Real simple stuff. It's either a reversal or it's not a reversal. It's not a reversal. No reason to have the stop any further away from that low, and more than likely it would be placed at the low, this low made prior to the entry. Let's just advance this a bit. So the important thing I want you to think about is how logical all these decisions are. So let's add some bars on here and see if we make a new low or we continue higher. Well, we just continued higher. So if we had a buy stop to go long above this high, where would our stop be? Well, we have a well-defined little intraday ABC here. The protective sell stop would be right below this low. So really minimal capital exposure for the potential of not just a multi-day, but probably at least a multi-week advance. So once again, potential for having completed, let's go to the weekly. Potential for having completed this 3-month corrective decline, and with a potential follow-through of another impulsive trend to well above this high. And we just were able to enter right within a day of the low so far. We don't know, we haven't confirmed that low, but this is a real good signal. It's way overbalanced time and price. Actually now anything since this wave B high, it's overbalanced both the 2 and the 4. That's a real strong signal that the market's reversed. What would confirm this 5-wave decline is complete? Well, of course, a trade above the wave 4 high. Let's just add some data. There we go. A day later, we traded above that high. More than likely, well, not more than likely, this 5-wave decline is complete, which should at the least, let me add the data on here, I'll go back to daily data, at least should complete this ABC decline from the February high. Very important setup. And again, here we can add a couple bars on. That's the bar we had as of on the 240-minute data. Great entry, minimal stop, high probability continuation of an impulsive trend, because what should follow a correction? Well, it should be an impulsive trend. If we have an impulsive trend, it will be a strong signal that we have completed the higher time frame correction. If we have another ABC type of correction or any other type of correction off of this low, then it would indicate it's going to continue its complex correction with a decline, correction, decline, correction, and then probably another, maybe a triple 3. I'm going to add some data onto this chart. And before we add it on, what's some more waypoints, more things we would want to look for? on the if the market continues to advance? Well, the first thing we want to look for is if we make a 5-wave advance on the daily data, or on the, let's say, the 240-minute data. That's what we'll look for. I'm going to add some data on the 240-minute. So I've advanced the data several days, maybe a week or two. And let's just take a look at this data as the market had advanced. Here's where we entered the trade, and the long side, the original stop was back here. My recommendation is to be very slow about it, adjusting stops. You should have a reason to adjust the stop. In other words, you're constantly asking yourself, what should the market not do if the trend is going to continue as anticipated? So the trend continued. This, I just labeled this was probably a 1, probably a 2. And then it advanced 1, 2, 3, 4, 5. And that's pretty clear cut. At least it appears to me to be a nice 5-wave advance, which should be a wave 3. So as the market advanced, let's just say around up in this point in time, and we were in either a wave 3 or a C, what should it not do? Well, it shouldn't come down and trade into the range of the wave 1. So the stop would fairly quickly, on your full position, would be adjusted to below the wave 1 low, or wave 1 high. So it ensures you at least a small profit. What would be the next waypoint to adjust the stop? Well, if we, from my point of view, again, if we make this wave 3, and that's a pretty significant advance that it's been made, and this is a potential wave 4 of 3, we always trade in multiple units. So half the position, I would stop it out below this swing low, which is, pretty clearly a wave 4 of 3 low. And then I'd leave the stop in the second part all the way back here. And I'll wait until this potential wave 4 correction is complete. And then if the euro does continue to do a new high, at that point, since a wave 4 is established, then advance the stop on the second part of the position below that wave 4. So let's add some data on here. And again, I hope you see the logic of all of this, is that if this is an impulsive trend, well, we already know it's an impulsive trend. And if this is a waves 1, 2, and 3 as labeled, then we should have another pretty good leg up that we'd want to participate in. That's the whole purpose of using Elliott wave and pattern analysis, is to recognize where the market is within a trend, or where it probably is. I'm going to add some more data on here. So as the last bar in the chart, look at this. A really nice correction was made here. We're going to consider that a wave 4. It could be an ABC, maybe an ABC, DE, flat correction. Never took out this swing low, which, by the way, is nice, but kind of unusual. So, but now that we've made, let's just put a wave 4 in there. Now that we've made 1, 2, 3, and 4, or probably have, we can move the stop on the entire position up below the wave 4 low, and this last little swing low before this last section began. That was our entry. This is where our stop is at this point in time. Probably it's about 10 days later than where the entry was, 2 weeks later it looks like. So how would we adjust the stop if the market should advance? Well, let's just advance it. And that if this breaks down, if a wave 5 nicely subdivides, we'll have a well-defined swing low where to adjust the stop. If it doesn't, based just on pattern, is that, well, certainly if it came up near this high, that's going to be a probable natural resistance. And it also probably be a good price point if we were measuring price levels. Now, we've got a whole nother section on end of wave price target zones. But certainly if the euro came straight up into that, I'd bring the stop really close to the market. Probably trail it at like the 2 or 3 bar low. So I'm just going to add some data, see if we get a nice, boy, we haven't got a nice swing low to adjust the stop to. But three bars here, that's the most bars is hung at any place. And again, this is something just, we call it executive decision, is that we've come up to this high, and everybody that trades euro is going to be aware of that, and that was basically a double top. So there's probably going to be some resistance there. It'd be almost a perfect place to complete a wave 5. So let's use a little bit of logic, since we don't have some well-defined pattern, and say we want to get the stop really close to the market. So let's just add some data. Boy, we're still hanging in there. There we go. Just got stopped out again. This is a real logical place that everyone that has a position the euro is going to be aware of. So long above here, we held the position. We adjusted the stop on the full position to the potential wave 1 high once we had this impulsive trend had continued for a ways. And then we waited to adjust the stop once we had this wave 4 of 3 swing low, which it never got hit, and that was only on half the position. Then we made what is probably a wave 4 correction, and once it took off to a new high, at that point we brought the stop up on the full position to below the wave 4 low. We hit resistance, and then we just looked at a little minor swing low before that resistance and brought the stop close to the market. All really logical based on the pattern position. So once again, really the key is to identify the probable pattern position, identify what the market can do to give you at least an initial signal that the pattern is complete, and then identify the probable pattern position once the reversal is made. Then adjust your stops logically, continually asking yourself, based on the pattern, what should the market not do if this higher time frame trend is bullish? And that's where you put your stop. That's how you adjust your stop. Well, let's look at a follow-up from that trade I just described. This is, again, Euro daily data, and this is actually up to date through the day that I'm recording this. So let's take a look at, this was where we went long about the day after this low. Really a nice setup. That was what you call an ideal high probability low capital exposure setup. And then we recognized a 5-wave advance and right into mid-April here, which came right up to this double top. But it only was sideways for about 3 days. And as you know, I was stopped out. We were stopped out in this example. But then the market just took off. 2 days later, after, maybe this is just the day after getting stopped out, took off, big wide range breakout day above this high, and did another 5-wave advance. Looks a little bit more like an ending diagonal based on closes. It wasn't, but based on intraday, definitely traded into the range of there. So I'd like to say caught all of that. Didn't. However, once this well-defined ABC correction was made, greater in time and price than any since the low back in March, that was another ideal setup to look to get positioned on the long side for what turned out another 5-wave trend over about the next 4 weeks into late May. So let me bring you up to date. This is Friday. It's only Thursday's data. So it's this is the end of the week, so there should be one more day of data. In this data source, I haven't updated it, but I can tell you nothing dramatic happened the day after this. So I'm recording this on Saturday the 25th, this example. And I want to show you how we use this. I know, you can say, well, these are after the fact examples. Let me show you exactly what we're looking at in the euro right now. It's coming off of the May high, probable ABC, which completed an A potentially, another ABC, possibly completed a B, and coming down from this early June high. This is almost textbook 1-2. Accelerated decline for a 3, and if that's the case, we're making a wave 4 correction, and when it's complete, the trend should continue to a new low. So what a beautiful setup this is, because it's a correction. What happens after a correction? Resumption of the trend to a new extreme. Now it should be the last section down of this 5-wave advance, but wave 4s are fantastic to trade because it's a mature trend that has a very high probability of occurring. I mean, this has a very high probability of being a 1-2 and a 3 and a 4. All efforts now are focused on identifying the end of this wave 4, which should be followed by continuation to a new low. So over at least several days. So great trade setup, I believe, coming up. You can check this out. You might be listening to this months or years after it was recorded, but you can go back and check it out and see if sometime in the latter part of June, last few days of June, if the euro didn't continue down to a new low. Now, if we look at the 240-minute data, again, there should be one more day's data on, but I can tell you we haven't taken out a swing low. And we haven't had a lower close. We haven't closed below. This is my real signal that this wave 4 correction is complete. At this point, it would be a close below that close that was made on that wide range reversal day. And that would be an important signal that the wave 4 is probably complete. And also we can look at this little trend in the 240-minute data. That looks really corrective, doesn't look impulsive. So that's also reinforcing the probability that we're making a wave 4 correction. And when we take out a swing low, more than likely we finish the wave 4 and it'll continue down to a new low. Elliott wave can really be helpful to identify great trade setups with minimum capital exposure and a high probability outcome. And again, you don't have to trade Forex. You can trade ETFs like the dollar and the euro, dollar index and the euro, trade exactly inversely. So there's a dollar ETF UPP. We get this signal in the euro on the short side, and we can always take a long for a 3 to 5 day trade in the dollar ETF, short-term trade, but real high probability.
In this lesson, we're going to emphasize that you don't have to pick the bottom and pick the top to be a successful trader. What you do need to do is have some understanding of the probable trend of the market and the position within the trend the market is. And there's no better way to understand that than with Elliott wave. So let's take a look at this data. This is weekly data of the biotech ETF sector, and the symbol is XBI. So this data covers more than 1 year's period of time. So let's take a look at this data and see if we can get an understanding of where the market is and if there's a good trade set up or not. So over this period of time, and this is from around September 2018 into this low here is March or April 2020, so that's a considerable period of time in the weekly data. Boy, we can just look at this and we say that is definitely just a textbook correction and a really prolonged ABC flat. And ABC flat, of course, is where the wave B terminates right around the beginning of the wave A, and the wave C is pretty much around the extreme of the wave A. So we got this ABC flat. What came after that low? Well, it's a very impulsive advance. I mean, it's just a clean 5-wave advance into this top into July 2020. And then we had an ideal ABC correction. And then as of the last weekly bar in the chart, XBI has advanced to trade above what I have labeled as the wave behind. That typically indicates that indeed it's an ABC zigzag and it's complete. What follows the completion of a correction is a resumption of the trend to a new extreme. And given that, boy, this was a really powerful, impulsive advance that lasted several months and many percentages, I think it almost went up 100% over that period of time. If this is a correction and if the next advance has anything even close to that, what a great trade setup. So before we go and look at the daily data and develop a specific trade plan based on the Elliott wave position, I do have an indicator, momentum indicator on this chart. Now I've got a complete course, that's a companion course to this course, on how to use dual time frame momentum indicators and momentum cycles, which are a great addition to your Elliott wave studies. But I just put this on to show you that this indicator just made, it's what we call a bullish reversal from the oversold zone. And usually when that reversal is made, we're 3 to 5 to even 3 to 5 weeks, up to 2 or 3 months with a net bull trend. So not only have we completed an ABC correction and then advanced to above the probable wave B high, we've just made this bullish reversal in the momentum indicator that itself would indicate we have several weeks, if not several months, of net bullish trend. So it confirms the pattern. So once again, we've got a whole course on that. We'll come back to that later, but it might give you a hint how you can integrate your other technical studies with Elliott wave to confirm or invalidate potential wave counts. Okay, let's go to the daily data. This is daily data right up through the same time as that weekly data that we just showed. And again, 5-wave advance to a new high. Remember, it was a 5-wave advance that took us to a new high above where the correction began, the higher time frame correction, that is. Let's go back to the daily. Completed a corrective decline. Oh, what a beautiful A, B, C, and the B was an A, B, C, D, E. This is like textbook stuff. And then we've continued to a new high as of the last bar in the chart. So here's what we know. We know that the trend began, potentially at least, began a major bull trend from this low back in March. That on the weekly data was a 1.5 years or so correction was complete at that time, that this market made a impulsive advance to a new high in this 5-wave advance. Now that could have been the last section of a bull trend, but it's not. The market has shown us that it's not, that it's just one section up. Then we have a correction. We're in a position for the correction to be complete. So right now, this market is in a position where you want to recognize that it's in the initial stages, or probably in the initial stages, of another major impulsive trend that potentially could be similar to this last impulsive trend. So we want to develop a trade strategy to go long. And as I've shown in some of the other examples, the simplest, most reliable trade strategy is to identify the probable position of the market, in this case, early stages of potential major impulse trend, identify a correction against the new trend, and then enter when the market's in a position to have completed that correction. So let's add some data until we recognize that the market's probably making a correction on this daily data. Then we can develop the specific trade plan, entry and stop. So I'll add some data onto this. Well, just immediately after breaking out above this swing high and confirming the end of this correction, XBI has made a decline and a correction to this initial advance. So that's the ideal setup to develop a specific go long strategy, so based on the pattern. So what would that be? Well, let me clean the chart up a bit here. Let me put just a line above this high, and I'm going to make it thick, and I'm going to make it green, just because I'm very visual in my charts, as you know by now. When we take that out, it means it's like a green light to continue the advance. Now, once again, we're not using any sort of retracements, any sort of price analysis, strictly looking for confirmation of the continuation of the bull trend based on the pattern. So let me add some more data. And what we're looking at, as long as we don't exceed this swing low, if this market comes up and takes out the swing high, that's a go long strategy with a stop below wherever the swing low was prior to making that new high. Simple strategy, logical strategy, in that if the market's in a bull trend and it makes a new high, it should not take out the prior low. So let's just add some data on here. There we go. As of the last bar in the chart, if we had a buy stop to go long, a tick above that high, which would be, that's the type of entries I use, where would your stop be? Well, if the market's bullish, if it's turned around to the higher time frame trend is bullish, and we've made the new high, it should not trade below that swing low. Simple stuff. Now, it may trade below that low, and that doesn't void that we're still making a correction within a bull trend. It would just mean it's some sort of complex correction. We already know it's a correction, or it should be at least. We never know anything, but it should be a correction. So anything that would continue to a new low would be part of a more complex correction. But right now, it's in that perfect position to continue a bull trend with a stop below that swing low. Let's add some data on here. Well, it just kept going, following that breakout. So what's it done now? Confirmed the correction is complete by making a new high. So in a great position to continue a bull trend. So I'm going to continue to advance the data, but let's continue to think about what the pattern should be, the ongoing pattern should be, if indeed this completed a correction to this 5-wave advance. This pattern should be impulsive and should continue a major impulsive trend if that's the case. So we've had one advance. You can see, by the way, I made this low thick in red. We've had an advance and a correction. I think typically we look at this as that's a 1 and a 2, and we're in a 3. So let me add some data, and let's continue. By the way, would we adjust our stop from where this low is since we made a new high? Typically, I don't. I don't adjust stops until the market confirms a continuation of the trend and we can identify a particular price that should not be exceeded. In this case, if the market came down in an overlap, would that indicate this is an ABC advance? Well, probably not. Why is that? Because this is a completed correction and we've continued to a new high. Something else would be going on, potentially a 1-2 and a 1-2. And the only reason I would consider that is because we've completed a well-defined correction, then we've gone to a new extreme. So we're going to favor a bullish wave count because the market is telling us that the trend is probably reversed to a major bullish trend. So we're going to favor a bullish wave count. We still want to exit the market for sure if it would decline below this swing low. Let's add some data. I've added several weeks of data onto this daily chart and expanded it a bit, so we show the data going all the way back to that March low where this whole impulsive trend began. So this is that original advance which lasted, I don't know what, several months, about 3 months or so, the correction, and then the resumption of the bull trend. So instead of just adding every single bar on and looking at the adjustments, we'll look at it in general. How would you adjust a stop? Well, you always adjust a stop to that point that the market should not go if the trend is going to continue as anticipated. So this happened to just resume in a very strong bull trend over the next several weeks. And we had an advance, just a few day correction here, another advance, about 2 or 3 days sideways, a new high. So in general, once we make a new high, we can adjust the stop to the swing low prior to the new high. Because if the trend is bullish, what should it do? Just simple. It should make higher highs and higher lows until we get to a higher time frame correction, which then could be ABC, which we'd take out a swing low, or some other kind of complex correction. But as long as it hasn't completed that impulsive trend, if one gets underway, then we can adjust the stop. Usually, if we make a correction and then a new high to where that correction was, until we're in a position to have completed the impulse trend. So let's take a look at the data up through here. Until the last bar in the chart is that this market would make new highs, corrections. Sometimes this is just a one-day correction, but it was a really wide range outside to close reversal day correction. And the next day it just turned right around and went to a new high. So typically it's pretty logical. If there's no follow-through on the downside, then more than likely it's going to continue to advance, so we can adjust the stop. Again, we made a new high correction. It was just a 2-day correction, but that's all we're getting through this entire period. And then a new high, adjust the stop, trail it relatively close to the market. Now, where are we at as of the last bar in the chart? Well, it looks like to me, this is an obvious 1 and 2, and then we can look in here. We can go 1, 2, 3, 4, 5 for the 3, probable 4. We're in a position to complete a wave 5 top, potentially of the wave 3. And when that is complete, typically we'd anticipate having a correction, something similar to this correction. We call that of the same degree. In other words, a correction of several weeks and much greater in time and price than anything within this advance. And of course, anything within the advance is only 2 or 3 days. So good time logically to bring the stop pretty close to the market, at least on half of the position. So let's just keep adding some data. Oh yeah, what else do I have on the chart? Just a couple of things that you want to frequently we add on to our charts to help us identify support and resistance. And that's just some simple channel lines. Elliott used these a lot, and I use them a lot. They're particularly valuable when we're identifying corrections. You know, later lessons and later courses we'll look at it more. I'm just kind of tossing it in there now because you often see these on charts. You want to be aware of them. So when you have a market that's either in a position for or nearing a position for a reversal based on, in this case, Elliott wave, it could be other technical studies, and it's approaching a channel line such as this, we call it channel resistance, then you have some chart geometry that's also indicating the potential for resistance or reversal. The other thing I have on this chart is just a real simple 100% alternate price projection of this advance. And again, we've got a whole course on price objectives, but that's just a real simple one that we see over and over and over again in the markets, that if we get near the end of a pattern position, and maybe there's some other technicals that indicate a potential reversal, the 100% alternate price projection is something we also want to be aware of. And again, that's not too far above the market. So we not only have some Elliott wave immediate pattern position that's indicating we're at or near a position to complete what will probably be a weekly high, a high that's going to last several weeks and complete this immediate advance. We're near some chart geometry and some key price relationships. Okay, let me add some more data on. So I hope you're following the logic of where we're at now. And there we are a few days later. For the first time since the low back in November that XBI had made a new high and come down and traded below a swing low, stopping out of the long trade, at least half of the position. So this indicates that this section of the trend, at least, is complete. And that was several weeks advance. And boy, I don't know, what was it here? Probably about a 50% advance. That's pretty significant, particularly given that we're able to enter relatively early on the resumption of this trend off of this corrective low. We're able to enter it right around in here. So we're looking at this on how we look at the market bar by bar to understand what is the probable position of the market based on Elliott wave pattern, how we take advantage of that position, and what the market can do to avoid that probable position. And then we develop specific trade strategies around those probabilities of what the position is and what the outcome ought to be. This lesson will be an example of how you need to look at a market, identify the probable position of a market, and then identify, is it possible that something else is going on other than what you anticipate and what you believe the wave structure is? Is there another possibility? We call that, in Elliott wave terms, is there an alternate wave count? And I always call it the dreaded alternate count, because most of the time, everybody familiar with Elliott wave should come to the same conclusion, most of the time at least, or at least let's say 8 out of 10 should come to the same conclusion. Much of the time, there is a potential alternate count, even though it may be a low probability, but you should be aware of it and then really consider closely as a market unfolds, given one count or the other, what should the market do? How should the wave structure be, etc.? So let's take a look at the S&P cash index. This is data. It goes back a ways to September 2018 and into the March 2020 low. This is, of course, the pandemic panic decline. Now, everybody listening to this knows how this came out. But I'm going to show you a big mistake I made, and that I was slow to correct that error. It's a warning for you on what to beware of, and don't make the mistake that I did. Not just in a situation like this, but in every situation. And the mistake is ignoring an alternate possibility and ignoring the signs of what a market is warning you that something else is happening other than what you anticipate. So here we are with this weekly data, this just sharp decline. Obviously an impulsive decline to a new low. So that's pretty significant, that it wasn't just a correction to this advance. I was looking at it because this was dramatic to a new low as a probable wave 1 or A, which would probably then be followed by a wave 2 or B correction, and then a resumption of the bear trend to test or exceed this March low. Now, I want you to look at this data off of the 2018 high, and which, by the way, it was a really almost 10-year bull trend into that high before we had this correction, then a new high, and see, could have there been an alternative to this decline being a wave 1 or a wave A? We'll address that very soon, but there was a clear warning that that was incorrect. Let's go to the daily data. This daily data through the period of when that weekly data was, and again, impulsive type of decline into the March low, probable 1, 2, 3, 4, 5. Looked like just textbook beginnings of a higher time frame correction or bear trend. And this is only a little over 4 weeks in time. It's one of the, I think it's the second most brutal decline in the history of the S&P, that it declined that percentage amount in that short a time. So if this were a 1 or A decline, what should we anticipate? Well, we should anticipate a correction a 2 or B correction, and a corrective structure, followed by a resumption of the bear trend to come down as a wave 3 or C to test or exceed that low. Let's add some data onto the chart. Well, as of the last day on the chart, is this a potential? If this is a 1 or A, we're making a correction, then this is a potential A, B, and wave C. And what would indicate that this correction may be complete, or is at least in a position to be complete? Well, if the SPX came down and closed in the closing range of this wave A. So let me put that on, and then we'll make it thick, and then we'll make it red, because if the S&P comes down and closes into that closing range, then the SPX would be in a position to have completed an ABC correction, which would be a higher time frame, wave 2 or B. Let's add some more data onto the chart. Well, there I've caught up the data, added about 2 or 3 more weeks of data. And what's happening here? Where are we at pattern-wise? Well, let me do a couple of things for you. Let's isolate that. Let's take this off and isolate this data. If you were just looking at this data, I'm going to take that label off. If you're just looking at this data, what would be the most probable wave count of this advance? Again, not considering what this low potentially could have been. Well, it doesn't look like a correction, doesn't it? It looks like an impulsive trend. So we had to be careful if we were convinced that the advance was making a wave 2 or a wave B, and we were prejudiced towards that, is that looking at this, not like a 5-wave impulse, but as a 5-wave correction, an A, B, C, D, E. And that's a very legitimate wave count up from this low, but it would certainly be secondary to an impulsive wave count, because typically if you have, this is very much an impulsive trend, but we do have A, B, C, D, E's where the D does not overlap with the wave A. And if we had some other technical studies besides the pattern position that very strongly indicated that this was a corrective rally, that would be a legitimate wave count for this advance. And what would indicate that would be in a position to have completed this wave E? Well, we came down and closed into the closing range of the wave C. So I'm going to add some more data onto this chart. So it came down, made a corrective decline. So if this is a wave E and it completed a wave 2 or B, let me just put some labels back here. What would be an ideal trade setup to get short or enter a bear fund? So we've already come down and closed into that range, indicating that if this is making a wave 2 or B, it should be complete. And by the way, I'm going to add something else on here. Even though this part of the course is not about price relationships, but as of this bar, it was right at the 62% retracement. I know most of you are familiar with that. It's a key retracement for a correction. So it sort of added some technical position that indeed the market was in a position to complete a correction. Okay, we had a decline, had a rally. If the market came down to take out this low without having exceeded this high, that's one of the high probability trade setups once we've identified the markets at the end of a correction. So once again, if we prejudice ourselves that this is a 1 or A and it has to be making a wave 2 or B, then we're looking at this as in the ideal position to have completed it. Even though if we looked at this data in isolation, it would look more like an impulsive 5-wave advance. I'm going to add some more data onto the chart. As of the last bar in the chart, we came down, made a low, a corrective high, and then we took out that low. Ideal setup on the short side, bear funds, whatever, to complete a wave 2 or B. So we all know what happened. Just a few days later, the market continued to advance to a new high, avoiding this as a wave 2 or B. voiding this as a probable ABC correction, voiding this as a probable 1 or A low. And if we looked at this data in isolation, what would it probably be? And if this were an impulsive 5-wave advance followed by a correction to this 5-wave advance, what must this be? Well, it could be a 1 or A. So we could label this as a 1 or A, a 2 or B, in which we still had quite a ways to go on the upside at a minimum to complete a wave C. And if it's a wave 3, then we got a long way to go on the upside. Labeling this a 1 or potential A and this a potential B when it's already continued for a longer time period than this decline. And it continued all the way to the 62% retracement and a 5-wave impulse is stretching it quite a bit. Again, if we looked at this in isolation and we're not prejudiced by this decline, considering that this, or thinking that this is a 1 or A, is that we would certainly be looking at this as a probable 1 and a probable 2. So once again, I'm showing you this example because it was a big mistake I made at this time, being very convinced that this was a 1 or A decline and we're making a 2 or B correction, even in the face of up through this point in time when it clearly was an impulsive trend and not a corrective trend. So I want to show you a mistake I made by making assumptions that a wave count I was prejudiced toward it like it was correct and not considering what the alternative could be. What could the alternative be to this decline other than a wave 1 or A? And again, I'm going through this in detail because it's not just this example. We can make these same type of mistakes with any market in any time frame. Sometimes it could be on just intraday data. So let me bring us up to date here. There we go. There's the 62% retracement. That's, whoops, excuse me. That's where we were at as of that daily chart. So let's go back here and say this is probably not a 1 or A, but it's definitely an impulsive 5-wave trend down. When we started this out, I asked you to look at this data and say, do you think there's any warning here that this is probably not a 1 or A decline? And I'm sure some other Elliott wave analysts picked up on this before I did. Very much prejudice, this decline, given that it was one of the most dramatic declines in the history of the stock market, and I have the history going back to the 1800s. Remember that we had one of the highest rates of unemployment since the Great Depression. Businesses were closing right and left, and definitely there was a dire outlook. But let's take a look at the actual market. Let's see where my mistake was. Let's go back and label what we know. Let's go back to this decline. Real simple, obvious, ABC. So here's a real clue. What was this going on? Is this an obvious impulsive trend? Boy, it was just, what is this? It lasted for about a year and 3 months, December 2018 into February 2020. So well over a year, went to substantial new high. We should be looking at this as typically something that long and that much of an advance would be considered an impulse trend. However, if we just looked at the pattern out of isolation, this is what you need to do. Look at it out of isolation. Don't consider where it is from coming off of this corrective low. Don't consider what happened after it. If we look at this, does this look like an impulse trend? And if it's not an impulse trend, then what is it? Well, if we looked at this out of isolation and didn't consider it was making a new high, I think we would probably all look at this as a probable something along these lines. Something along those lines. Again, look at it out of isolation. Don't get prejudiced from what came before and what came after. We know a clearly defined ABC came before. We typically anticipate an impulsive trend after that to new highs. Certainly went to significantly new highs over well over a year after that time period. And yet, if we looked at this advance out of isolation, it certainly looked like an ABC correction. Fit all of the rules and guidelines of an ABC and the subdivisions. The difference was it went to a new high. What sort of pattern or wave structure could have a new high within it and still be part of a higher time frame correction? Let's go backwards. If this is part of a correction, it's the obvious impulsive trend. Correction should end on an impulsive trend. We go backwards. This is the first part of the decline, an ABC. A wave A can subdivide into an ABC. This is a corrective advance divided by an irregular running ABC, which turned out to be a wave B, for a probable wave B. And of course, we know what eventually happened after this. So the lesson here, and this applies, this is an obvious dramatic example of this, but the lesson here is when you believe you've identified a wave structure and a trend or a section of a trend or a counter trend, whatever, is look at it in isolation to identify what it should be, and then expand the data a bit coming into the reversal and out of the reversal and say, could it be something else? What else could it be? And is there an alternative that also fits all the rules and guidelines? So it turned out in this case that this, of course, was not a wave 1 or A of a bear trend. It was actually the last section down, a wave C, the final section of an irregular correction. So the lessons learned is, or the lesson learned, and by the way, this is, of course, a dramatic example, well after the fact, of course. But throughout these lessons, I've tried to emphasize that look at the current section that you believe meets all the rules and guidelines for that type of section, and then look at what came before and what should follow. And is there an alternative, an alternate, and what can the market do to confirm or invalidate the probable position of the market? This is the ES daily data, and we've used this time period for the ES, for example, on a correction in a prior lesson, this time period right around here. I'm going to pick it up and see how we can use this information for some particular trade strategies and for entry, and how we judge and how long to hold that position, and how to adjust or stop, that sort of thing. The ES is one of the markets that I trade very frequently, both in the futures markets and then as the S&P bull and bear markets, or I should just say stock indexes, bull and bear markets. You can use this information that we're talking about. We don't have to use it just on futures markets, as we can also use it for setups on very low leverage. So we can take advantage of every market turn where maybe the capital exposure would be too great on the futures markets, or the highly leveraged markets. But we can ratchet down to low leverage, like one of the bull and bear ETFs, to take advantage of identifying the end of corrections or trend continuations, etc. So let's look at the ES here. And as of early March, we made this ABC correction. And if you remember from an earlier lesson, this was a wave A down, irregular ABC to complete a B, and then a wave C. And as of the last, not the last bar in the chart, but the bar where my cursor is, we closed into the closing range of the last swing low, indicating the wave C was complete. But then the market just continued almost straight up out of that end of wave C. And let's just say we didn't feel comfortable entering the market during here. We didn't get a nice setback, or maybe we just weren't paying real close attention. Maybe we were out of town, as we didn't take advantage of identifying the end of this ABC correction. No problem. More than likely, the bull trend is just continuing, and this section up potentially could just be a wave one of a new 5-wave trend. It depends on what the higher time frame position was, that sort of thing. But if we get an advance, and this is definitely an impulsive advance, and if we make another correction and we complete a correction, then what does it have to be? Well, it really has to be a wave one. So we made a correction, a new high, and then if we make a correction and then continue higher, this just about has to be a wave one of a new 5-wave series. So as of the last bar in this chart, we're in a position to have completed an ABC correction. We've come up and closed into the closing range of what I got labeled a wave A. What would confirm an ABC correction is complete? Well, a close above the wave B closing high. And let me just color that in. There we go. So more than likely, that's a wave one. It wouldn't be an A and we're making a B and then a C, because we're continuing to a new high. So it's not against the higher time frame trend. So probable ABC, we've probably completed that ABC correction, and we can put the little wave C down here, and we'd have a question mark by it, because until we've confirmed that it's a completed ABC by closing above 39.30, it's a question mark, and this would be a question mark, a wave two. Now, in general, is a wave three, well, in all cases, wave three should be an impulsive trend. The only situation where it may not be is when we have what's called an ending diagonal. But for right now, let's just assume it's going to be an impulsive trend, because that's what happens 90 to 95% of the time. So a wave one to a new high, a correction, and we want a position for that potential wave three. So what's a trade strategy? A real simple trade strategy that allows us to enter. So one actually could be enter on the close, when this close was into this range of the wave A. Now, for futures markets, that's going to give you probably a much larger stop than you'd be willing to take. But certainly, and this is what I do, is take advantage of it with an ETF, either a low leveraged ETF or a mild leveraged ETF. Now, I also trade futures. So let's say I'm looking to take a futures trade, a highly leveraged trade. What we're looking for is the market to advance, have a correction, and then we can enter at the end of that correction and the continuation of the trend. So this is the 240-minute data, and it has the data up through that last bar in the daily chart, when we were making a correction greater in time and price than any correction since we began this section up, which we're going under the assumption that it's a wave three. So the trade strategy becomes pretty simple here. At least it's the one that I use all the time. Once we're in a position for the continuation of the trend and we've identified a correction, and that is we take out this little swing high. That's called a trend continuation signal. And so go long on a stop at a buy stop 39.7150, tick above that high. Where would we put our protective sell stop if we entered the market on the long side? Well, would we have to put it all the way back here? Of course not. That was the whole purpose of waiting for the initial correction and continuation of the trend, because then we can put our stop at the swing low prior to entry. Now, I don't know if we're going to go above that yet, but if the market happened to go straight up and exceeded 39.7125, the stop would be just below that swing low. Very minimum capital exposure for the potential of another advance even greater than what I got labeled the wave 1. So let's add some data onto the chart. There we go. So the last bar of the chart, buy stop to enter the market 39.7150, a tick above the swing high. Sell stop, tick below the swing low 39.7 or 39.3350. So a fantastic opportunity to get on the long side with minimal capital exposure for the probability of the continuation of an impulsive trend. Let's add some data and let's see how we would adjust the stop as the market continued. That is, if the market continues in the anticipated direction. Well, this is back on the daily data. And boy, right after that entry, market just took off for a couple of days, very strongly on the upside. So my theory of adjusting stops is to adjust them very slow unless you have a specific pattern or technical reason to trail the stop close to the market. And of course, now we're just concerning ourselves with the pattern. So let's look as of the last daily bar on the chart. Well, no, let's look after these two strong up days. You do want to adjust the stop to break even as soon as it's logical. And your stop is always adjusted to that spot to which the market should not go if the trend is going to continue as anticipated. But after these two strong up days, which help to confirm that this is an impulsive trend, we could certainly adjust the stop to break even. And that's pretty good if you can adjust your stop to break even within a couple of days of entry in the market. So then we had a few more days, a couple of days here, a sideways and a new high. So what's happening here? This was just on the daily, we can see, was a correction greater in time and price than anything since entry. So good possibility. This is a 1. Again, we're looking at the probable Elliott wave, a 1, a 2, and possibly a 3 and a 4 working on a 5. So again, another impulsive trend up for a higher time frame, wave 3. We got 1, 2, and we're working on a 3. So if this is the case, where would we just adjust our stop? Because what should the market not do? Well, it shouldn't take out a wave 4 of 3. Now, it depends a little bit on your trading time frame, but certainly, from my point of view, if you've entered on a probable wave 3 in the early stages, the wave 4 is probably going to be fairly significant because the wave 4 is usually comparable in time and price, if not greater than the wave 2, then I would be looking to capture as much as the wave 3 as possible. And I'd only begin trailing the stop real close to the market if we're in a position to have completed the wave 5. So we've got 1, 2, probable 3, 4. Now I'd go down to the smaller time frame to see if there's any information that I might be missing and look at the data up through this date. So this is the data through that last day on the daily chart. Initial advance, probably a 1, a 2, and then another just relentless impulsive advance for several days, and then we had a couple days sideways and then the new high. So this looks like a comparable correction to this area in here. So potential 3 and a 4, and it's in a wave 5 high. I see no reason to not adjust the stop below this swing low, which is a probable wave 4 low. Let me add that in there. So ensuring a fairly substantial profit if the market did turn around at that point in time. So this is a very logical place to put the stop. Let's just add some more data on the market and see what happens. Well, I've added several more days worth of data onto this chart, and it turns out the S&P just had a relentless bull trend for the next several days, not even making a correction equal to what we're looking at as a wave 4 or a wave 2. So can you subdivide this into a nice Elliott wave pattern on the upside? Well, I can't. All that I know at this point in time is we're making little higher highs and higher lows. Now, keep in mind, each 4 or 5 or 6 of these bars, each 6 of these bars is a new day. This is 240-minute data, and this is a 24-hour-a-day market. But once we get to an extreme like this, my suggestion is then you start bringing the stop at every minor swing low. So each time it makes another little swing high is that adjust the stop to a minor swing low. So as of this point in time on the last bar of the chart, the stop would be around 41.13. Now this has turned out to be just a great situation, but is this just some kind of ideal pie in the sky situation? No. We identified a very clearly well-defined end of an ABC correction and the beginning of a probable wave 3, which typically wave 3s are greater in time and price than the wave 1. So we're looking for probably fairly substantial advance to a new high. And that's what occurred. How would we subdivide this? Boy, I don't really know. When we get into some time and price relationships in another course, is that we can have some price targets for different end of waves, and that would give us another indication if we're getting near the end of that trend. But as far as a wave count, it's not subdividing nicely. We just have to take advantage of this market continuing to advance until it gives us some indication that the wave 3 is over. So let's just add some bars on the chart. Certainly at this point in time, we'd have our stop around 41.13. Well, just below that. Well, there, as of the last bar in the chart, just got stopped out of the long position taken back here on this trend continuation setup. Now, would we exit the entire position? Well, probably, given that this is an extended probable wave 3, and we're probably going to have a correction somewhat similar to what I got labeled as the wave 2. So I'll go ahead and add some more bars on the chart. Well, so far it looks like we made a pretty good choice here. Been sideways for a number of days. It did end up now making a new high. Is this the wave 4? And are we going to make another new high? Well, this was kind of a sloppy correction. It was an irregular ABC, or at least that's what it looks like so far. Let me add some more data on here. Made some upward progress to a new high. So indeed, we have probably finished and completed the wave 3 and the wave 4, something along those lines, either the 4 here or the 4 there. And that this, at least since what I've got labeled as this wave 3 began, this was far greater in time and price than anything within the wave 3. And that's a pretty strong signal that it's the 3 and the 4, and we should be near the end of a wave 5. So let's say we're already stopped out of this, which, we probably would be. If we're getting near the end of a wave 5, is that a trade we'd want to take on the short side? Well, from my point of view, if we believe we're in a position to complete a wave 5, is I want to see a decline and then a correction and then a continuation of the bear trend. And much the same way as we completed at ABC, we had the initial advance, the initial correction, and then the trend continuation after that correction. So in other words, it's the old WD Gann entry strategy that I mentioned several times in this course, is that the best and safest time to enter a trade is following the initial reaction against the new trend. And in Elliott wave terms, that is, we look to identify the end of a wave 2, or we look to identify the end of a wave B. In this final lesson for this chapter, we'll take a look at two, maybe three examples that we looked at much earlier in the course, which I recorded, in some cases several weeks, maybe even 2 or 3 months earlier than the one that I'm recording right now, and we'll bring them up to date. Always keeping in mind that we're using that pattern position to help us identify the position of the market, potential reversals. Pattern position can do to confirm the probable trend or the reversal, and some specific trade strategies that are developed from the probable pattern position. So let's begin by taking a look at gold. This is gold weekly data. And I think we first took a look at this around in April sometime, coming off of this March low. So we went through in quite a bit of detail in an earlier example how this decline should be a correction within a much higher time frame bull trend. This is weekly data, by the way. And so our objective earlier when we looked at example was to identify if it was in a position to have completed a correction. And I believe we looked at it sometime around, it would be mid to late April time period, where my cursor is here. And we're looking to identify if the market were making, and what would be the conditions for it to be making an impulsive trend, because what should follow all corrections? What pattern? Well, it should be an impulse trend in all cases. If we, whatever the pattern of the correction, whether it's a simple A, B, C, or a complex correction, once that correction is complete and the market continues in the direction of the higher time frame trend from before the correction, it should begin in an impulse pattern. That's actually one of the real keys to understanding if a market has reversed. So I've updated the data through early June here, and again, it's weekly data. So let's take a look at a couple of things to set the stage about where we might be. And the first thing we look at is this advance is much greater in time and price than any of the advances since this correction began. The corrective decline began in August. These were 3 to 4 days sideways, or 3 to 4 weeks or so sideways to up. These have been much longer in time and much greater in price than any of the prior corrections. And as you know by now, we call that an overbalance of time and price. It's at least a wake-up call that the trend is reversing to bull. So that's one piece of information that's important. More importantly, though, just look at the pattern coming up from the March low. I'm not going to label it, but does that look more impulsive or corrective? Remember when we just started this whole section of the course, way back in chapter 1 or 2, is the first thing we want to identify is that market probably in a correction or an impulse trend. Well, it looks to me certainly more impulsive than it does corrective. Can we label this as just a perfect 1 through 5 impulsive trend? Probably not. But what we can do is we can look at this and say not only is it much greater in time and price than any of these rallies prior to this period of time, it's come up and tested the prior swing high, hasn't closed above the closing high, just drew a horizontal line across the weekly closing high. It looks like it just about tagged it here a couple weeks before the end of this chart, but it really looks impulsive. And so more than likely, the higher time frame trend is reversed to bullish. This is a corrective low, and eventually gold will continue on to a new high above the August high. Now that's just what the information is telling us. So now we got to update the information and see if it confirms that or invalidates that. So and we'll add some bars on here in a minute, but if this is an impulsive advance, if the trend has continued bullish, then any declines should be corrections within a bull trend. So we just want to add data. We want to see if we get in a position to complete a corrective decline. So let's do that. Let's go down to daily data and see how pattern can help us identify if the market gets in a position to to complete a corrective decline prior to the resumption of a bull trend. So this is the daily data, and I've added about a month's worth of data on. And let's take a look at what's happened since this June 1st high, this decline. If we were anticipating that gold would be making a corrective decline, is it in a position to have completed a corrective decline? And is this decline a corrective pattern, or is it an impulsive pattern? Well, it looks like a textbook 5-wave impulse pattern. At least it's in a position, as of the last bars in this chart, to be a 5-wave impulse pattern. So we know that a correction should not be complete on a 5-wave non-overlapping impulse trend. So this should not be a completed correction. What can it be? Is it voiding that the higher time frame trend has turned bullish and that this is the beginning of a bull trend? Well, not necessarily, but it just can't be a completed correction, or it should not be. So let's label this, and then let's see what it could be. So let's just assume that that's a pretty good label. That wave 5 may not be over yet, but since it's made a new low and a new closing low, it's at least in a position to make a wave 5. So what could this 5-wave decline be? Well, it could be a wave 1 of a resumption of a bear trend, and this was not the resumption of the bull trend, or it could be a wave A of a correction. So let's label that. Let's try not to prejudice ourselves that it's one or the other. Could be an A, it could be a 1. Regardless if it's an 1 or an A, what should follow whenever this 5th wave is complete? Well, a wave 2 or B correction, and that should be take the form of some sort of correction. So I'm going to add some more data onto the chart. So I've added quite a bit more data onto the chart, and here was that wave 1 or 8 in late June. This definitely turned out to be a corrective advance. It looks like an ABC, kind of an irregular ABC, and then continued down to a new low as of a new low, at least below the wave 1 or A low. As of the last bar of the chart, boy, we had just a collapse in prices here these last couple of days. So if the higher time frame trend is bullish, and if we're completing an ABC correction, where are we at as of the last bar in the chart? Well, we're approaching the low in March. Whether we look at this is a double bottom low in March, we're approaching that. So we're really at the extreme of where the market could be if it's making a correction. So that's a really good place to be from a trade strategy standpoint, because if we're at the extreme from where a correction should be, we're in a position to immediately consider long trade strategies, particularly if we have some other technical information that's indicating that we're making some sort of a low, maybe a weekly low or something along those lines. But we're looking right now just at pattern, and pattern-wise, great position to consider an immediate long trade. What can the market do to indicate this indeed is a corrective decline? Well, what's a characteristic of corrections? And it's an overlap. So a closing overlap into the range of wave 1 or A would indicate that the market's in a position to have completed an ABC correction. So I'm going to just draw that low close in right there. And if gold should reverse and close above 1763.60, it would indicate strongly that this is a correction, and the correction is probably over, not only because it closed above the closing low, but also as of this bar, it was very near the beginning of the advance back in March. So great information. You don't have to forecast. You just have to identify the probable position of the market based on the pattern position. Now, of course, if the gold continued to decline, and certainly if it traded and closed below the March closing low, then that voids this as a probable ABC correction, and more than likely it's a 1 and a 2, and a higher time frame bear trend has continued. I'm going to add a little bit more data. Well, there we are 3 days later, 4 days later, after this brutal decline of a couple of days here, is gold turned right around and closed back into the closing range of what's labeled a 1 or A. So more than likely this is an A, and this is a B, and this is a C. And that's a fantastic piece of information to have. Now, based on pattern, if this has completed an ABC correction, what sort of pattern should develop off of that early August low? Well, it should be an impulsive, non-overlapping pattern, probably 5 waves without those closing overlaps. And if we get that, if gold happens to do that on the upside, then that's further signaling, giving us more information that a higher time frame ABC correction is complete, and eventually gold will continue the bull trend to a new high. Now, that's not forecasting anything. That's identifying the probable position based on the pattern. So we identified back here, boy, we're really in a position for immediate long trade. Now, most of us, and I recommend this most of the time at least, is you wait until the market gives you a signal that the reversal has been made, that indeed this is the end of an ABC correction, and that would be a close above the closing low of the 1 or A. So now we've made that, and of course now, because it's been a pretty sharp advance in these last 4 days, now we're considerably above this swing low. So what's that trade strategy that we've been looking at over and over? Is that it's the old WD Gann strategy is that the safest and best time to enter a trade is on the initial reaction against the new trend. Well, right now we're in a position to say we've probably begun a new trend. So this should be an impulsive advance, and then we should have another correction followed by resumption of the bull trend. So if we did not enter a trade right around in here immediately when we're near this extreme on the downside, of which that would be nice, but how many of us can pick a bottom like that? Like I said, my strategy is usually to wait to get some confirmation of that reversal. Well, I'm going to add some more bars on the chart. I'm actually going to move into a later contract just because we're getting to the point contract is going to expire. So this is the December contract, December 2021, and it actually has data up through the day that I'm recording this. So once again, it's just like we do in our DT reports. When I use examples in the trade tutorials, I use them with data that's right up to date so we can identify in real time, so to speak, specific trade strategies. Well, here we've added quite a bit of data, another couple, 3 weeks since the last bar that we were looking at. And again, it continues to be a bullish type of trend and come up almost to test what I got labeled as a wave 2 or B high. So our assumption is this is an A, a B, and a C, and the bull trend is going to continue, and that this is an impulsive trend on the upside, and whenever it's complete, we should have a corrective decline followed by a resumption of the bull trend. So it should be, if this is a corrective decline. By the way, let's take a look at the close-only data, because that's what I've primarily been looking at for the past few weeks in this market, because it clarifies it a little bit. Definitely, this looks like a bullish advance. Again, 5-wave decline, 3-wave correction, and then a decline to a new low on a closing basis, not as close to those lows as it was on an intraday basis. But then we look at this on a closing basis. Again, impulsive advance. So at some point in time, I believe in the very near future, we should have a correction that's going to last a few days, and that's going to give us the specific opportunity to develop a specific trade strategy on the long side. So I hope you see how we use pattern to help identify the position of the market, the probable reversal, and then set up the conditions to develop a specific trade strategy. That's what we're looking at gold now as of, this is September 1st when I'm recording this. And the data is right through September 1st, is that this initial advance is probably not complete. Well, it's probably complete a couple days ago, but then we still have to wait for a several-day corrective decline. Should take a clearly identifiable pattern correction, and boy, that's going to be the opportunity on the long side. Again, we're not forecasting, we're identifying opportunities and conditions with a high probability outcome, and then we use our trade strategies to take advantage of that. This is Bitcoin and its daily data. Coming off of this July low, really looked like we had an impulsive advance. So again, should an impulsive advance complete a correction? Well, it shouldn't. It should be either a wave 1 of a higher time frame impulse trend, or at the least, if this advance is part of a correction, a wave A of correction. So we should have a wave 2 or B corrective decline, and boy, those are what we want to be alert to for almost ideal trade strategies. So we want to take a look at this market and identify a particular trade strategy. We want to get long Bitcoin for a probable advance, not just to above this high, but typically it'd be fairly similar in time and price to this advance that's labeled a wave 1 or A, and that was substantial. That was a very substantial advance in percentage terms. And if you don't trade Bitcoin itself, is that there's an ETF, for instance, I think it's GBTC, very high volume ETF that follows Bitcoin pretty much tick for tick. So that's available if you don't want to trade on the Bitcoin itself. So let's take a look at the data as of the last day on this chart. This is daily data. As of the last bar in this chart, we just had really just a 3-day decline, and this was an outside bull reversal. Really, we call that a snapback bull reversal day. It's not clearly a corrective decline, but it's in a position from which a correction is typically made right around the extreme of what I got labeled a wave 4. This is a pretty nice impulsive advance, 1, 2, 3, 4, and up. And if we did close-only data and evened out that bar, see, it's pretty much straight up, 1, 2, 3, 4, into this wave 5 high. So we're in a position to complete a correction against that advance. And we made an outside day. So we might go to our intraday data if we have that available. We don't have to be following it during the day. We can take a look at it as of the end of the day and see if this looks like a completed correction just based on pattern. We know it is, and price-wise, it's in a position, but let's see if we get an idea on the pattern. So here is the decline into the August 4th low. And if we look at this data, intraday data, it's 240-minute data, that clearly looks impulsive. So typically, it would not be the completion of a correction. It itself would probably be a wave A, we'd have a wave B advance, and then a wave C that would, as I always tend to say, test or exceed the low of a wave A. I'm going to put that in. But I'm going to add some data on. I'll add it onto the 240-minute chart here. And was the blue bar, that's the next day. That would be August 5th. And there we go. We had fairly significant decline. We actually had a new low on this bar. Again, these are 4-hour bars. But indeed, we've had this decline. We had an advance, and then we had a decline to a new low as of the last bar in the chart. What would be a specific trade strategy that we could consider to go long that should be pretty high probability and indicate that this indeed is a completed correction, that this is the 1 or A and we've completed a 2 or B? Well, I can put a couple labels on here. This would be potentially a B, potentially a C, and I realize that particularly the wave C is pretty short in time and price compared to the A, but the point is we had an impulsive decline, we had a corrective advance, possible B, and we did indeed trade to a new low. So there's nothing saying yet that this is a completed ABC. We'd have a question mark on that, but here's what I would do, and here's the specific trade strategy. A trade above this swing high would be a pretty strong signal that we've completed this correction, higher time frame correction, and would continue the bull trend, of course, well above this August 1st high. So that's the trade strategy. Enter above the wave B high. And then where would we put our stop? Well, the stop would be below the low made prior to entry, wherever that might be. Now, that looks like a long ways away in the stop. You just don't do high leverage. Do low leverage. Do like the BTC ETF. Something along those lines. Do low leverage so you can take advantage of this information. Oh boy, I just added one more 240-minute bar on, and boy, that was a pretty powerful up bar. Well, more than likely, as of this date, this is the 5th, we've completed a wave 2 or B correction. We should be long in the market for a probable continued advance. I'm going to go back to the daily data, and let's add one more day on there. That's the day that we're just looking at. Probably for continued advance, something similar to what I got labeled a wave 1 or A. So let me just put this label on, and then let's follow this up for a while and see when we're in a position to complete this advance. So I'm going to pause. I'm going to add some more data. So I've advanced the data a week or so into, this would be August 13th, had a big update to a new high after having a correction. It looks like it could be a 1, 2, and a 3, and a 4. If that's the case, we're probably fairly close to having a high similar to this high. It'd be a wave 3 or a wave C high. And followed by at least a corrective decline lasting several days. So this is where we get into 2-unit or multiple unit trade strategies as well. If we don't have a firm opinion whether the market's making a C or if it's making a 3, we'd probably want to bring the stop on at least half the position quite close to the market, leave the stop in the other half a little further from the market in the event that it's making a wave 3 and then it's going to have a wave 4 correction followed by a continuation of the bull trend. So let's look at a couple of things here that we'd want to be aware of. And we'll go down to the intraday data here in a minute. If this is in the potential for making, let's say, a wave 3, in the long run and the days ahead, what should the market not do? What should Bitcoin not do? What should not trade, or close in the closing range of the wave 1 or A? And I realize that's a long way from the market, a long way to make a decision like that, but we want to be aware of what the market could do, should not do, at all times as the market progresses. And if we go down to the intraday data, we want to take the first signal and first pattern position that indicates at least that this section is complete. So let's go to the intraday data, and let's do that. Well, again, this is the 240-minute data as of the last bar that we showed in the daily chart. And if we look at this advance, if we believe this is potentially a wave 5 of 3RC advance, pattern-wise, what could the wave 5 or what could the data do to indicate the wave 5 is probably complete? Well, looking at the intraday data, it looks like a little 1, 2, 3, 4, and then a 5 up into a new high. So we could just draw a line across here, something along those lines. And by the way, we don't have to be watching this market intraday. We can look at this data at the end of the day to develop our trading plan or where we place our stop and all that sort of thing. But if Bitcoin should turn around and trade below this little swing low, basically where it went sideways, which is also below the wave 3 high, and so it would be overlapping into the last swing high. Again, typically a impulsive trend doesn't do that. That would be a pretty good indication that at least this section up, which we're calling a wave 3RC, should be complete. And we'd want to exit the market. I want to get a few more, there we go, a few more bars on it. So two unit trading at least, we'd exit at least half of our position on a trade below 46.015. And we'd maintain, and this is how I look at it at least, we'd maintain the other half of the position with a stop all the way down to around the 42.237, which is would be a close below that. Or we could even make it a trade below this high, because that's quite a ways away from the market. In that if, again, this trend is bullish and this is making a wave 3 and not a C, then it should not trade into the overlapping range of the wave 1 or A. Now realize, again, that's quite a bit ways from the market. It would also depend a little bit on what we believe the higher time frame trend is. In other words, what was the trend coming into this July low? Was it pretty clear that we should be making a correction, or may we be making an impulse trend? If it's clear we were making a correction, or at least if it was more probable correction, then we exit both positions. We'd exit the entire position, I should say, when it traded below this wave 3 high. But if this has a strong potential as just being a wave 3, let's hold on to the other half for we might have quite a bit more to go on the upside. So let me go back to the intraday, and we'll add some data on and see where we're at in the days ahead. Well, just in the morning of the following day, we traded below that low. Be a good position to get out that we've probably completed this 5-wave advance. What would we be looking at now? And this is real important. So let's label this. And again, we always want to be thinking, there we go. If this is a wave C, then any decline, the pattern should be impulsive. Because if we've completed an ABC correction and we're resuming a bear trend, then the first section coming off of the end of wave C should be an impulsive pattern. If this is a wave 3, then the trading off of this high, again, we'll assume that it continues sideways to down, but the trading off this high should be the pattern of a correction. So that's what we want to be alert to, is the next section off of this high, is it a correction or is it an impulse? If it's clearly a correction, it's probably making a wave 4 of higher time frame. If it's an impulse, it's probably making a wave 1 of the resumption of the bear trend. So first of all, we made a slightly higher high. I'm going to move this over or mark it off like so. And let's add some more data onto this chart. I'll just add the intraday data here. There's another couple days. Let me take these off. Look at this data. What does this indicate pattern-wise that's happening on this decline. Does that look corrective or does it look impulsive? Well, it really looks corrective. So we're making lower lows, lower swing lows, lower swing highs, but each time we make a new low, then we come back up and we trade into the range of the prior decline. Again, swing low, trade back into the range of the prior decline. What does that indicate? That indicates this is probably a correction. It's probably a wave 4, not the beginning of a bear trend. And when it's complete, Bitcoin then should continue in a wave 5 to a new high. So if we've maintained half of our position, what could the market do that then we'd adjust our stop closer to the market? Well, should the market make a signal that this correction is complete, we want to adjust our stop and anticipate would probably make a new high. So anytime we take out a prior swing high, once we've identified as a correction, it has the probability, or at least the possibility, of having completed this correction. I'm going to add some more data on the chart. There again, we made a new low. As of the last bar in the chart, we've broken the pattern of lower lows and lower highs. We've probably completed some sort of correction here, and what should probably be a wave 4. So let's change this. I mean, this is fantastic information and how to follow a market logically as it unfolds and as it gives us more information. If this is a completed wave 4, then more than likely Bitcoin is going to continue to a new high to complete the wave 5 in a much higher time frame. Great position to adjust our stop on the other half of the position just below this low. What day is this? Let's take a look. This is the 19th, so I'm going to add that data onto our daily data. I bet that's 19. That's it. Ooh, that was a big outside. We call that a 3-close reversal day. That's a day where it made a new low and then it traded up above the high of the prior bar. Now it makes an outside day and then it closed above the closes of the past 3 days. Pretty powerful up day. More than likely, let's fill this in. This is great information we got here. And there we go. So more than likely, this is a 1 and a 2. We'd have a question mark on the 4 because that's not confirmed until we make a new high. But I'm going to add some data on here. So we've adjusted our stop from around 42,600 up to this low on the second half of the position. We've already exited half of the position. But, oh boy, big up day the next day. So since we've made a new high, we're in a position at any time to complete a wave 5. The other thing we want to look at is at any time we've completed a smaller 5-wave advance here, that could complete the wave 5. So very important. Let me put that low on. So we can go back to our intraday data, and since we've now traded above and made a new closing high, we're at any time we're in a position to have completed a wave 5. So I'm going to go to our intraday data. I'm going to add some data on. Let's take a look as of the last bar on the chart. This was that big up day that we had, and then this is the first bar of the next day. What's this pattern? Is that impulsive? Is it the potential for a wave 5? Sure looks like it to me. And again, we don't have to follow this during the day. We don't have to get frantic during the day. We don't have to do highly leveraged. We just have to identify what is the probable position and what can the market do to indicate that the higher time frame trend is complete. Well, as of this point in time, just to trade below this possible wave 4 low indicates that this wave 5 is complete. Now, the wave 5 may continue for long ways, but as of this point in time, the last bar in this chart, it has the potential for completing a wave 4. So here's what I'd be looking at We've made a little swing low and a new high. I want to advance at this point. I want to advance this stop at every minor swing low once we've reached the extreme position to complete that pattern. There we go. We just declined below that low. I can take those out. Those were potentials. Now what we've done for the first time since we made the new high, we declined below that swing low. We're in a position to have completed wave 5 of 5. This is the 22nd. I'm going to add some more data onto this chart. And that's the day, and there we go. This is the day stopped out. What does this look like now? I just think this looks like a beautiful 5-wave advance, of which we caught the majority of what we've got labeled as a wave 3, held on to half a position to the majority of what we got labeled the wave 5. So pretty significant. We didn't pick the bottom. We weren't even looking at this market until after it had made this 5-wave advance. There may have been a setup to buy near this low, but we don't necessarily get to pick all the lows, exit at all the highs. But we want to recognize the position of the market and take advantage of it. So I love this example and with Bitcoin, and once again, a lot of you may not be interested in Bitcoin, but what you learn here is applicable to every market and every time frame. And again, even if you don't trade Bitcoin itself, think about trading the ETF, GBTC. In this final chapter to the Practical Elliott Wave Trade Strategies course, I'm going to talk a bit about the strengths and weaknesses of Elliott Wave. First, let's talk about the weaknesses of Elliott Wave analysis. Too many traders get E-wave paralysis of analysis when they try to put E-wave labels at every little section, and they lose sight of the bigger picture. As you learned earlier, I rarely look at more than 3 degrees or time frames of subdivisions to get all the information needed to understand the trend position and make a specific trade strategy. When you see wave counts with more than 3 degrees of subdivisions, you are probably seeing the wave counts of an academic analyst, not of an actual trader. Start with a time frame, whether weekly, daily, or some intraday data, where you have confidence in the E-wave count and position of the market. Then see if you can fit that into the larger time frame trend or counter trend, and then see if you can subdivide into one smaller time frame. If the Elliott wave is not obvious to you, don't label swings just for the sake of labeling and trying to appear you understand the market position. Follow the basic rules and guidelines to try to understand if a market is making a trend or a counter trend and where it may be within that trend or counter trend. Forced wave counts are a huge problem with Elliott wave academics who want to be forecasters, not traders. A forced wave count is when you make the wave count fit a preconceived notion of the trend of the market. Also, a wave count that is used to make a long-term forecast for a market is also rarely the product of someone who actually trades successfully. Note this anytime you see a wave count of a supercycle, for instance. I've seen a lot of them in the past 35 years, all forecasting we're on the edge of financial and economic doom, and none have come to pass. Some critics claim there's too much interpretation of wave counts. They claim that if there's 10 Elliott wave analysts, you may have 5 or 6 or more different wave counts or interpretations of the market position. This is nonsense. If you have 10 Elliott wave traders who are grounded in the practical application of Elliott wave rules and guidelines like you've learned in this course, at least 8 or 9 of them should have the same interpretation. There's always one rebel. So please beware of Elliott wave paralysis of analysis.
with the symptoms of trying to label every squiggle in the market from intraday to monthly data. Beware of forecasting the future, which is not how actual traders use Elliott wave. And beware of forcing a wave count just because you have a bullish or bearish view of the economic and financial future. After over 35 years of using Elliott wave as an important part of my trading plan and teaching practical Elliott wave trade strategies, I continue to find it the best method to identify if a market is in a trend or countertrend, and if the market is in a position to complete the pattern or wave structure of the trend or countertrend. I don't know of any other technical analysis that is so useful. It is particularly useful to help to identify if a market is in a position to complete a correction in order to develop a specific trade strategy to enter a market in the direction of the trend prior to the correction. I believe as long as we are well grounded in the practical application of Elliott wave analysis and trade strategies, the strengths will always far outweigh the weaknesses. A quick note regarding Elliott wave software that purports to identify the wave counts on any series of data. One word: beware. Elliott wave counting software can run from the relatively useful to the very misleading. In all cases, never use E-Wave software until you are firmly grounded in the basics of practical Elliott wave and the rules and guidelines, so you'll be able to judge if a software wave count is useful or not. In 30 years, I've become familiar with almost all Elliott wave software, and I'll warn you not to blindly rely on it to identify the Elliott wave market position. What's next? The next course of study in this series is the dynamic price trade strategies, which goes way beyond simple fib retracements and emphasize my unique end-of-wave price target zones. I hope you'll join me in that course to round out your knowledge of practical Elliott wave trade strategies from entry to exit for all markets and time frames.